Hello, and welcome to Berkadia's 2022 Forecast Webinar event. The event is now live. Please note that all lines have been muted and will remain muted throughout the duration of the event. Without further ado, I'll turn the program over to Justin Wheeler.
Welcome, everyone, and thanks for joining us for our webinar. I'm Justin Wheeler, CEO of Berkadia, and I'm joined by Berkadia executives and partners to recap 2021 and discuss the themes that we expect to shape investor behavior and the multifamily housing market in the year ahead. Without overstating the obvious, 2021 was an incredible year for the multifamily industry. Resurging payrolls, a wave of new household formation, and an ever-growing barrier to home ownership helped fuel robust apartment fundamentals. We also saw leasing activity reach its highest level on record, and all of this against a backdrop of pandemic and related economic uncertainty. Entering 2022, we still live in that challenging environment. That said, commercial real estate activity, acquisition, refinancing, and so forth continues, and rent growth and occupancy are expected to easily outpace pre-pandemic levels. For many reasons, I'm very optimistic about our industry and especially about our organization as we enter 2022. A tidal wave of maturing loans, coupled with historically low interest rates, a growing pool of yield-hungry investors, and continued liquidity support from government-sponsored entities all point to a bright future. One personal note, Berkadia is continuing our evolution from a transaction company to an advisory one. It's been inspiring to watch members of our team make it their personal mission to assist our clients to find clarity amid the ongoing pandemic. This has required learning new skills, employing different tools, and collaborating much better, and all this from their makeshift home offices. I'm confident we will increase our capabilities to help our clients make the best decisions that build their businesses and best their competition. Today, we're fortunate to be joined by Aneta Markowska, Chief Financial Economist at Jefferies Financial Group, to help us better understand the current economic landscape and its impact on commercial real estate. Jefferies is our sister company, and it's a pleasure for us to find more ways to work together. After Aneta's remarks, we'll hear from several of my colleagues at Berkadia who will provide broader market context to our conversation, and then we'll close with a short Q&A segment. Aneta, take it away.
Thank you very much. As I was getting ready to start to speak, I got a notification on my phone from the Wall Street Journal saying mortgage rates just hit their highest level since March 2020 as the prospect of Fed rate increases pushes up borrowing costs. So it's a great time to be talking about the economy and as it relates to interest rates and the housing market. So I think we would all agree that inflation is the #1 economic issue or question facing investors at the moment. I want to actually start by talking about the labor market. Why? Because the inflation debate is settled. There was a big debate in the second half of last year whether inflation would prove transitory or not, and that is settled. The Fed has acknowledged, obviously, it's not transitory. It has been a lot more persistent than we hoped or than many anticipated. But the debate among investors has really now shifted to the next two questions. The first is, how long is this inflationary pressure going to last? And secondly, what is it going to do to the real economy? Will it squeeze purchasing power and ultimately cause consumption to crack? And are we going to lose growth momentum as a result of this? Or can the economy actually flourish alongside this elevated inflation? And the answers to both of those questions lie in the labor market, and that's where I want to really focus on today. And my view is that we are headed toward the tightest labor market conditions since the 1950s. Just think about it. This is not just in my generation, this is also in my parents' generation. And that is going to create more wage inflation that we've gotten accustomed to. We're already seeing that to some extent, and I think that will continue. And that will ultimately, one, sustain inflationary pressures, maybe not at 7%, but I think around 3% is where we should anticipate inflation to remain for the rest of this year and into next year. But I think the labor market can also sustain end consumer demand and allow us to maintain that strong growth momentum. So let's start with looking at where the labor market is today. Here's a picture of job demand. And one of the reasons I think we're headed for the tightest labor market in decades is because labor demand is just unprecedented. There are a lot of different measures of job openings. Here's a few of them. They're all painting a very consistent picture. There are about 10.5 to 11 million job openings at the moment. And that's 3.5 million more than we had before the pandemic. Since the pandemic, working age population, so your labor supply, really hasn't changed all that much. In fact, it declined a little bit because working age population isn't growing, and we've actually lost some people, unfortunately, due to COVID. So there's still some slack in the labor market. My favorite measure of slack and how many more people can we potentially bring back into employment is the employment to population ratio. And based on that, I still think we can bring about 2.5 to 3 million people back to employment. But again, we have 3.5 million more job openings than we had before the pandemic. So at the end of the day, there are just not going to be enough people to satisfy the current demand for labor. And that means that labor will continue to have a lot of pricing power. I expect the unemployment rate to decline to 3% by the end of the year. We are at 3.9 right now, which is already historically pretty low. 3% is a rate that we have not seen again since the 1950s, right? And so when anything is scarce, what happens is the price goes up, and it's no different for labor. And you can already see wage inflation rising at a pace that's unprecedented, right? We've exceeded the prior cycle peaks in terms of wage inflation, and the unemployment rate isn't even as low as it was at the end of the last cycle, which was 3.5%. So what we're seeing is, one, a structurally tighter labor market, but also what we call a steeper Phillips curve, meaning that for any given level of unemployment, we're actually seeing more wage inflation than we saw not just before the pandemic, but really in the last 3 decades. And so if we really stay on this steeper Phillips curve, meaning if we maintain the relationship between wages and unemployment that we've observed over the past 6 to 12 months, my 3% unemployment forecast implies that wage inflation is going to accelerate sustainably toward 5.5 to 6%. And again, that's something we haven't seen in a long time. And there really isn't any amount of productivity that can fully offset that. Even if we assume that companies are very productive or people are very productive, the 5.5 to 6% wage inflation is consistent with inflation around 3%. And that's where I think we're ultimately headed to. Just another way to show the unprecedented kind of power of labor at the moment is in the quit rate, which has increased to 3%. That's the highest on record. And you can see that the layoff rate has absolutely collapsed. So it's the labor that's calling the shots, and just given the outlook for unemployment and where labor demand and supply are today, this is really unlikely to change. So how does this all feed into inflation? Well, obviously, supply chain issues are keeping inflation very, very elevated at the moment. We're at 7% as of now. I think we'll stay there for another month or two. And then I expect inflation to start normalizing, in part because I think it was really exaggerated in the fourth quarter by just the seasonal surge in demand around the holidays, and that really intensified product shortages as a result of constrained supply, particularly in shipping across the Pacific. As seasonal demand slows in the first quarter, I would expect that pressure to abate at least a little bit. But again, we're not going back to 2% inflation. The labor market's telling us that wages are going to put a floor under inflation at 3%. And that's not what the market's priced for. The market's still priced for the idea that inflation is going to maybe not 2, but 2.5%. And if I'm right and we settle at 3% or a little bit higher, that still implies even more Fed tightening than what's currently priced into the curve. So that sort of answers the first question. Yes, inflation will be sticky and will be pretty sustained. And it's going to take a lot more tightening to ultimately push it lower. The second question is, will it hurt growth? And I strongly believe that consumers are in a position to absorb these higher prices. What's really unique about today's labor market is not just that we're seeing unprecedented wage inflation, but it's really skewed toward the bottom end of the income distribution. So you can see here that people who are earning the lowest level of wages have actually enjoyed the fastest wage inflation or wage growth this year. Take a leisure and hospitality worker who is at the absolute bottom end of the income distribution. They've experienced wage gains of almost 14% this year, right? So yes, they're paying 7% more in prices, but their wages have gone up a lot more. So you have people really in a lot of industries beating inflation, and that's preserving their purchasing power, and that allows demand to be sustained. And you could see it in the set of charts on the right-hand side as well, is that, again, it's really people with low level of skills, low level of education who are outperforming everybody else. And that is absolutely unprecedented. That's something we haven't seen in a long time. And again, I think that helps to sustain consumer demand. Another thing that will help sustain consumer demand, and I think this is really what's causing a lot of the inflationary impulse in the first place, is that fiscal policy has fundamentally transformed the financial position of households. So here you can see that the aggregate household balance sheet has never looked as good as it does today. Households have amassed $2.5 trillion in additional cash compared to what they held before the pandemic. And that's not just the wealthy, that's almost across the entire income distribution. Even if you scale it by income, people are holding more cash today than they did since the 90s. The median household before the pandemic had roughly 3 weeks of savings, right? So if they lost a job, they became desperate very quickly to replace that lost income and take any job that was available. Today, they have 3 months worth of savings. So that creates a luxury of time, and that creates leverage. And that's one of the reasons that, you are experiencing these high quit rates and much more wage inflation than we've seen in a long time. So when you combine, a robust labor market, I think we can create another 2.5 to 3 million jobs this year. You couple that with wage growth of 5.5 to 6%. That's a lot of income that's still being created. And then on top of that, if households spend some of the accumulated cash, that still supports very healthy consumer demand. Not only for services, that's clearly where most of the upside is, but even for goods. And we're already buying 23% more stuff, quote unquote, than we did before the pandemic. So again, it's sort of a virtual self-reinforcing cycle between wages, sustaining inflation, and that sort of feeding on itself in a positive way. So I don't think this is necessarily a terrible kind of inflation that's going to kill growth. I think what this is also going to do is really incentivize businesses to invest in a way that they have not been incentivized. It's really since the 1990s, right? Given where demand is today, if supply were to catch up very quickly, and the reason it hasn't is because we've been consuming out of inventory. You see how much retail inventories have declined, and they will have to be rebuilt at some point. But if supply catches up to current levels of demand, that puts capacity utilization at 83%. Again, haven't seen that since the 90s, and that creates a tremendous incentive for businesses to invest, because if they don't, they just won't be able to meet demand, and they'll be leaving revenues on a table, and that's clearly not what they want to do. Do they have the firepower to spend and expand capacity? Absolutely. Corporate balance sheets are as healthy as they've been. You can see very similar to households, a lot of cash, profit margins still very close to record highs, and very, very healthy interest coverage ratios. So, this notion that there's too much leverage in corporate America and they won't be able to spend, that's just simply not the case at the moment. So again, my bottom line is inflation sustained, yes, but I don't think it's going to derail growth. I think we can fairly easily produce 4.5, even 5% real GDP growth this year. And again, a lot more gains in the labor market. So finally, what does this all mean for the Fed and for Treasury yields and ultimately for mortgage rates? So what the market is priced at the moment, the market has certainly accepted finally this idea that inflation is not transitory and that the Fed will have to respond, that it's not just going to fix itself. Which is what many people hoped for last year. So we are now pricing about 4 rate hikes in the next 12 months, and really a total of 8 rate hikes over the next 2 to 3 years. I still think that that's not enough to ultimately push inflation back to 2%, right? What's different this time is that for the first time in a very long time, the Fed will be trying to achieve the 2% inflation objective from above, right? In the last 2 cycles, really the goal, we were below 2%, and the goal was just to gently, direct inflation toward 2%. And when you're trying to do that from below, it doesn't require aggressive tightening. Trying to push inflation from 7 or even from 3% back to 2 will require, in my view, more aggressive tightening from the Fed, and the market's still not priced for enough. So I think there's still more hikes that need to be priced in, not necessarily this year. I think for this year we've priced enough, but into next year and the year after that. And as the market does that, and it'll probably do so gradually because there's still a lot of doubt about the economy's ability to really withstand higher prices and higher interest rates. And the market needs to see the proof before it really reassesses, kind of what the ultimate terminal rate for this cycle will be. So I think this will be a gradual process, but I do think the terminal rate is too low. The idea that, again, a 2% funds rate is somehow going to fix inflation. And by the way, a 2% nominal funds rate, you're still talking about a negative real rate, right? So that's just not enough tightening to ultimately bring inflation back down to 2%. So I do think that there will be continued upward pressure on rates, particularly at the longer end of the curve. My best guess is that the 10-year Treasury will end the year at around 240, which is about 60 plus basis points higher than it is today. But again, I believe that will be gradual because there's very much a lot of skepticism about the sustainability of inflation and the ability of the economy to withstand it. And so we really need to see the proof, and that will be a gradual process. And that is it from me. With that, I will turn it over to Marianne King to talk about recent trends in the multifamily real estate market.
Thank you so much for sharing your perspective, Aneta. All of our clients are trying to figure out how to calibrate and recalibrate their investment strategies in a post-COVID era. And your comment on labor markets and on inflation and interest rates have definitely helped set the stage for those strategic conversations. Thank you so much. In this next portion of our presentation, we're going to explore some trends in the United States apartment markets. First, we'll look at some long-term trends that we see continuing and even accelerating as a result of COVID. And then we'll look at some emerging trends that seem sure to impact returns over the decade ahead. We hope that this focus on trends will help our clients refresh their investment strategies and fine-tune their thinking about how to invest their capital in 2022. The amount of capital attracted to the apartment sector has increased dramatically over the last 20 years. Ever since the REITs went public in the 1990s and apartments became an accepted asset class for pension fund investors, we have seen a steady increase in the amount of capital that flowed into our sector. Apartment sales have skyrocketed from less than $22 billion in 2001 to $256 billion last year in 2021. Although the GFC caused our capital markets to freeze and resulted in a decline in commercial real estate investments of all kinds, in general, apartment investments have continued to win increasing favor over time. And we see nothing on the horizon that should disrupt capital flows to our sector at this point. So over time, this flood of capital has bled into a much broader geographic area. As you can see from the graph on the screen, As recently as 2012, approximately 50% of all apartment investments were concentrated in only 5 major markets: in Dallas, Atlanta, LA, New York City, and Phoenix. But by 2019, investors had broadened their geographic focus, spending 70% of their investment dollars across a much broader landscape. COVID has certainly accelerated the geographic dispersion of capital in the apartment sector, but it was a trend that was already well underway. So where did all this capital come from? Well, it really came from all types of investors. Private capital and private buyers continued to dominate the buyer profile in 2021, representing 65% of the capital deployed in our sector. But the search for yield attracted other types of buyers as well. 24% of all apartment sales were purchased by institutional buyers, and 11% by REITs, foreign capital, and other investors. Portfolio sales were at an all-time high, representing 22% of all apartment sales in 2021. So even though we all expect interest rates to rise in 2022, we do and still expect the appetite for apartment investments to remain strong from all types of apartment investors. So now that we've described the increasing demand for investment product in the apartment space, I'd like to turn for a moment to the supply side of the equation. So no surprise here, but as a nation, our apartment markets are chronically undersupplied. And as the bar chart on the screen shows, over the last 9 years since 2012, we've developed an average of only 300,000 units a year, while absorbing an average of 342,000 units a year. So last year, apartment absorption was exceptionally strong. As a nation, we absorbed 673,000 apartments and only delivered 364,000. So RealPage reports that this level of apartment absorption is the highest level on record since they began tracking apartments in the early 1990s. So even though we do expect deliveries to increase in 2022, the supply-constrained profile of our apartment markets is expected to continue. So as a function of this chronic undersupply of rental housing, we've seen consistently strong rent growth and strengthening occupancies over time. Over the last 9 years, average rents have increased an average of 4.4% a year. And while rents have been on a steady march upward, occupancies have also been increasing from 94.5% in 2012 to 96.6% by 2021. The consistently strong fundamentals in the apartment industry will continue to make it a beacon for investment capital. So with the supply of apartment product constrained and an increasing number of investors chasing this product, cap rates have continued to compress. As this chart shows, cap rates have fallen relatively consistently, a full 380 basis points from a national average of 8.5 in 2001 to only 4.7 by year-end 2021. With this flood of capital into our sector continuing, we don't see this cap rate compression reversing its course. But despite the strength and durability of these national trends, we all invest in submarkets and in product types that we hope will beat the national averages. So what are the trends that are emerging that suggest which submarkets, which product types, and which investment styles will perform the best over the decade ahead? I see at least 10 emerging trends that investors should consider as they chart a course for their investments in 2022. The first trend is that macro migration patterns are changing. Most people are not aware that population growth in the United States has slowed dramatically overall. The entire US population grew by just 392,000 in the year ended July 1, 2021. However, the South, including Florida, the Carolinas, and Tennessee, added 658,000 during that same year. So where did all these people come from? If I was showing you a map here of the United States, you would see that they came from our country's major urban centers in California, New York, and Illinois. Investors will need to consider the direction and durability of macro migration patterns as we transition to a post-COVID world. But, macro trends certainly don't tell the whole story. The next trend is that micro migration trends matter too. So despite what the popular press reports, not everyone in California is moving to Texas. And as a resident of Southern California, I know that Los Angeles, a market that's been one of the markets hardest hit by COVID, is right next door to the Inland Empire, a market that is one of the top performing markets in the country. The chart on your screen now shows where the 196,000 households that left Metro LA actually went. As this chart shows, about a third of all of those households that left LA went right next door to the suburbs. They went to the Inland Empire. 58% of them stayed in the state of California. Only 5 to 7% of them moved to either Las Vegas or to Phoenix, and only 2 to 5% of them actually moved to Texas. So investors shouldn't redline any entire region or even any entire metro areas based on the popular press. Acquisition teams will need to consider and assess the direction and durability of these micro trends to assess the prospects for outsized rent growth. So the third trend that I want to talk about today is the trend in single-family rentals. Single-family rentals have transitioned from a niche investment to one of the hottest and fastest-growing investment products in commercial real estate today. And there are far more single-family rentals than I think most of us realize. Of the 44 million rental units in America today, approximately 37% of these are single-family rentals. There are actually more single-family rental units than there are multifamily units. So technology has developed to the point where scattered site rentals can be managed efficiently. And rents in this space have been growing faster than ever. Rents in single-family rentals grew 13.8% in 2021, compared to only 10.5% in the multifamily space. Most of the institutional owners I know are trying to build a meaningful presence in this space. So you should expect to see more activity, more growth, and more investment in this growing sector. The fourth trend I'd like to talk about today is one that I'm going to call the Jpa Trend, and that is a scalable capital markets solution has emerged in California to provide affordable housing for the missing middle. And these deals are referred to as JPA deals. Now, JPA stands for Joint Powers of Authority. And Joint Powers of Authority are affiliates of the state of California, and as such, they pay no real estate taxes. They also have the ability to sell long-term tax-exempt bonds. So, a JPA can buy a brand new apartment property at a price above that which a market rate buyer might pay. He could finance 100% of the acquisition price with long-term tax-exempt bonds at between 3.5% and 4% today, and still have enough cash flow to rent restrict 100% of the units to households that make between 80 and 120% of the median income. So JPA deals are a way of using public ownership and municipal bond finance to purchase and rent restrict rental housing for the missing middle. This structure has taken the California market by storm. 36 deals in the state of California over $50 million in size were sold to JPAs. And this represents approximately a third of the sales volume of all apartment sales over $50 million in the state. Recently, these capital structures have come under increasing scrutiny for excessive sponsor fees and for relatively small rent relief relative to the amount of real estate taxes foregone. And although the JPA deals address the affordable housing problem for the missing middle, they will likely become less competitive as interest rates increase. But in 2021, they were a significant force in restricting the volume of opportunities available to other market rate investors. So there are at least 6 other trends that investors should be aware of as they develop their capital strategies for 2022 and try to define ways to outperform the markets. We don't have time to talk about all of these today, but I'd like to just kind of list them for your thoughts and know that we will be bringing these topics back to all of our clients for a much more in-depth review as the year goes on. So some of the trends that investors are going to be watching are these next 6. They're certainly going to be watching the impact of an increasingly complex web of legislative overlays, like rent controls or eviction moratoriums on project and portfolio NOIs. They're certainly going to be watching the pace and profile of alternate urban recoveries. They're going to be watching and looking for the impact of changing work patterns on locational and product preferences of renters. They're going to be noticing the increasing appetite for workforce housing investments on their large institutional clients. They're going to see and understand the increasing focus by capital providers on the ESG profile, goals, and accomplishments of the sponsors they choose to work with. And they're certainly going to become more cognizant of the increasing focus by management companies on smart home, digital communication, and self-guided leasing technologies. So today we've shared with you our summary of trends in the U.S. apartment market. We've looked at trends that are visible today and highlighted those that we see forming on the horizon. Berkadia is committed to providing our clients with as much transparency as we can on these trends so that all of you are in a better position to refresh your own portfolio strategies and build your own businesses. In order to do that, we will be hosting a series of webinars that we're calling our Strategic Insights series to explore each of these trends in more detail. We want to help you see around the corners to make the best decisions for your investors, your clients, and yourselves. Berkadia is built for the now and the next. Now, my incredible partner, Keith Meisner, Berkadia's co-head of investment sales, will share with you the results of our Power Poll survey and let you know what our producers are seeing on the front. Keith?
Thanks, Mary Ann, for that in-depth market. It's always great to see you. I wish we could be together. I'm thrilled to be with you all today to share what we're anticipating for the year ahead. As Justin mentioned, 2021 was a tremendous year for our industry and for Berkadia in particular. We're carrying that momentum and optimism into 2022, as evidenced by the results of our latest Powerhouse poll, which is our biannual survey gathering insight from our investment sales advisors, mortgage bankers about the trends and forces that they think will shape commercial real estate activity and opportunities in the coming year. Launching our Outlook survey every year is exciting because we get to hear directly from boots on the ground about where they think the industry is heading. Their insight is essential and illuminating. It marries the national perspective with exceptional regional expertise to provide a comprehensive outlook. For this 2022 Outlook survey, we continue to ask our producers how COVID-19 pandemic is affecting commercial real estate. But after a year that we saw the multifamily industry bounce back tremendously, we also inquired about the new areas of focus, similar to what Mary Ann suggested, SFR, BFR, ESG, affordable housing. They are all shaping the future of investment. So what do we learn? You'll find that a lot of what we're hearing, again, is what Mary Ann was talking about. Optimism endures. 85% of our producers said they expect that transaction activity in 2022 will either stay the same as or exceed 2021. And after the year we've just had, that's impressive. Some of this is because 82% of Berkadians, we refer to our people that work at Berkadia as Berkadians, expect multifamily demand to continue to outpace supply. And there's still a huge appetite to deploy capital in the market. 61% of Berkadians agreed that actively pursuing acquisitions will be the most prominent investment trend in 2022. So all this is adding up based on what we heard from our other presenters. COVID-19 trends. Overall optimism aside, one of the biggest takeaways from this year's survey is that our professionals believe that many of the key trends we saw emerge or accelerate during the pandemic are here to stay. Secondary markets will continue to gain traction. 61% of our professionals indicate that they see the most investment sales activity there in 2022. Suburban migration will continue to see growth as 37% of our professionals strongly agree that since the pandemic started, renters have flocked to suburban areas over urban areas. Unsurprisingly, as a follow-on to that, and kind of a theme you're going to hear about us more and more, is the SFR, BFR space. Our own stats show this as well, and I'll get to transactions in a second. But 38% of our professionals expect this space to be extremely active, and particularly so for institutional investors. Inflation and interest rates. Now, of course, there's always a few notes of caution. This isn't the first or last time you're going to hear about inflation and interest rates. I mean, we've already heard about it from everyone else today, and I'm sure Hillary after me will talk about it too. Among major trends, though, think of the other trends. Other than interest rates and inflation, we have regulations, tax policy changes, and so forth. More than 50% of our professionals rank interest rates as having the greatest impact on the financing part of what we do. In terms of which major industry trends will have the greatest impact on the investing part, 46.5% of professionals ranked inflation as the #1 trend. So it's interest rates and inflation. Our research department has been digging into the topic of inflation deeply and has put out some great stuff on the impact of inflation in the multifamily space, which I encourage everyone to take a look at if you haven't already. But suffice it to say, we're tracking inflation and the Fed closely and actively working these key considerations in how we approach opportunities with our clients in the months ahead. These are just a few highlights from the 2022 Outlook Powerhouse poll. There are even greater insights on the key areas to track in the year ahead, including the appetite for affordable housing and the state of financing. So be sure to check out the full report when we send it. With that, let me segue over to the investment sales practice. It's been quite the year across commercial real estate industry, especially in multifamily investment sales. Many of us believed 2021 would be a bounce back year from 2022, but I'm not sure any of us really predicted the 75% year-over-year increase of transactions that our industry appreciates, right? As Marianne shared, the market was hot in 2021 as capital was competitively deployed into the space. Fundamentals surged and cap rates compressed. While true for all investment sales, that was especially true for us here at Arcadia. In 2020, we closed nearly $8 billion in investment sales volume. That was the whole year. Last month alone, we closed over $7 billion. That rounded out our record-setting year for 2021, concluding 762 investment sales transactions for close to $27 billion in volume. So what does that mean for you? That means we have deal currency across all sizes and all geographies for you to consider. And when you decide to sell, we have deal flow that will help drive pricing for you. Our deals are truly across the country, and they range from $5 million deals up to $300 million deals each. Let me provide you with some more specifics. Texas is our largest state with over $5 billion last year. California came in second with $3.3 billion. We've expanded in Florida recently, and they closed $3 billion last year alone. Arizona's are always a hot market, right? And it was our fourth most active market with $2.3 billion. And then finally, in the Mid-Atlantic region, we closed close to $2 billion last year. Now, in addition to the surge of conventional multifamily sales in 2021, we saw specific specialty asset classes bounce back at Berkadia. We have a national hotels and hospitality practice that year over year doubled. We have a national student housing practice team that year over year doubled. Our affordable housing practice stands alone, though. At the end of 2020, you might remember that we acquired Lytech Advisors to enter into the space in a meaningful way. That team last year in 2021, that specialized team in affordable housing, closed on 62 properties totaling up to $1 billion. One last area to highlight at Berkadia Investment Sales here is our focus on the institutional quality assets. If you recall, around a year ago, we merged with Moran & Company, and Marianne got to be my co-leader of investment sales. At that time, we launched a brand known as Berkadia Institutional Solutions, powered by Moran. The combination of their expertise plus a strong roster of institutional focused advisors across the nation led us last year to close a record-setting 85 institutional grade properties totaling $8.3 billion. That's just about a $100 million average deal size. Each of these transactions leads to more opportunities for us to better serve you, whether you're looking to expand or consolidate your portfolio. We now have more than 160 experienced advisors, marketing and closing all three institutional, mid-market, and private capital transactions across the country. So no matter what your strategy is for 2022, I assure you we are here and available and ready to assist you. Now, finally, you've heard already the prognosis of another very strong year in 2022. I won't belabor the point, as I wholeheartedly agree that barring any unforeseen changes in market dynamics, I expect 2022 to be another strong year for investment sales. I will now pass the mic to Hillary Provence, our EVP and Head of Mortgage Banking, for a mortgage banking update.
Well, Keith, thank you so much. How exciting to follow you, my partners, Keith and Marianne, with what was such a positive investment sales update, and Aneta as well, who kind of gave us the insight on both inflation and interest rates. I want to thank all of our customers who joined us today, as well as many of our lender partners who are on the call. And that's what I'm going to update folks on, is where was the financing market in 2021, and where do we think it's going in 2022 with a focus on multifamily. Now, we all knew going into last year that we weren't going to be able to rely on Fannie Mae and Freddie Mac the same way we had in 2020. FHFA had lowered their caps to $70 billion each, and it enhanced the need for other capital sources to step up. And step up these sources definitely did. They answered the call. Every lender in the multifamily market last year demonstrated a very strong appetite for originating loans, and they all increased their holdings of mortgages last year. While the final numbers from the MBA haven't been released yet, the MBA did project that the market would originate around $578 billion of loans backed by CRE. That would be a 31% increase from 2020, and just below the record volume that we saw in the market in 2019 of $600 billion. Now, Freddie Mac last week did release their projection for multifamily originations, and they cited a $450 billion market size last year for commercial loans in multifamily, which is a 25% increase year over year from the record topping $360 billion. So kind of follows on what Marianne said. It was a much larger market from an acquisition standpoint, and ergo the debt market as well. We heard from Marianne, the fundamentals are continuing to drive this investor demand, and it's also driving the lender demand here, and the need for really creative structured financing for these acquisitions. And there really wasn't a problem in that arena at all. Life companies and commercial banks were unbelievably active last year, but really the biggest story of 2021 was the emergence and competitiveness of debt funds and bridge financing options. There were over 100 new funds in the market offering competitive rates and proceeds last year, often making these executions more attractive compared to established options like life cos and banks. Now, as background, many of these funds are capitalized by the same institutional investors, both domestic and international, that Marianne referenced. A lot of these investors are really looking to diversify their real estate strategies. And so they're moving down the capital stack and putting money to work on the debt side of the business in addition to the equity side. These funds then leverage the capital and securitize the mortgages they originate as CLOs, collateralized loan obligations. And the securitization market on Wall Street was incredibly liquid last year for these executions. We saw 45 billion of CLO issuance, up from 9 billion the year before. So that's kind of how the engine is getting revved. And this allowed the debt funds to offer interest rates comparable to rates offered by banks, and often much higher leverage than we see with traditional capital sources. We are looking, some of the debt funds now are considering ways to offer longer term financing structures, but really the vast majority that we see here are still short-term loans focused on transitional properties and strategies for owners. When we back up and look a little bit at the CMBS market last year, it did grow 90% year over year, but that's not saying much from 2020. Traditional conduit issuance increased 16%, and that was mostly just the increase of hotel and retail loans being securitized. So we saw a little bit more of that in CMBS. But the big story in CMBS land was the SASB market, the single asset, single borrower market, a 300% increase year over year in volume there on these large borrower structured CMBS deals. And that represented 71% of CMBS issuance last year. And I think we see that trend continuing into 2022. And as we kick off 2022 in general, we do anticipate kind of a status quo business as usual from a financing standpoint. Similar sources of capital will pick up the slack where the GSEs may be still limited, including life companies, banks, and debt funds. Now, Fannie Mae and Freddie Mac will continue to be the benchmarks for the multifamily financing industry. We all know by now that FHFA did raise their 2022 caps to $78 billion each. So that's an increase from the $70 billion last year. But they are requiring that at least 50% of their multifamily business be mission-driven affordable housing, and at least 25% has to be affordable to residents at or below 60% of AMI. So you're going to see the most aggressive pricing and proceeds from the GSEs continue to be for their affordable and mission-rich business. And, you know, as we look at the year, there's always the possibility that FHFA could increase their volume cap mid-year if the market demands that liquidity. We don't currently anticipate that being an issue, but it's nice to know that there is that safety valve there. Focusing a little bit more specifically on Berkadia, last year we originated over $40 billion in production volume for our clients across these various lender programs. And that was a 50% increase over our 2020 origination volumes and our record origination year. So one thing that we're exceptionally proud of is that $10.5 billion of volume was originated with our partner Freddie Mac, giving us a 15% market share there and allowing Berkadia to be Freddie Mac's #1 multifamily lender overall. So we're very proud of that. And we also got the top spots with Freddie on both affordable housing and seniors housing. We also remained a top Fannie Mae lender, coming in at #3 nationally with them and increasing our market share year over year with our partner Fannie. And our HUD originations held very strong, $3.5 billion of originations with HUD. Our pipeline remains the strongest it has been in our company history with HUD. And we're also very encouraged that HUD just approved the use of contractors. So we're hoping that the pipeline speeds up and we can get more deals through HUD more quickly in the coming months. In 2021, our life company, bank, conduit, and debt fund origination partnerships with lenders made up 45% of our total originations. And that was a sharp increase and consistent with the market dynamics that I described earlier. We originated over $4.5 billion with life insurance companies, and our relationships with over 100 debt funds resulted in a volume explosion for our clients in 2021, where we did over $8 billion of originations. And this surpassed the prior 10 years combined of $5.5 billion. So thank you to our partnerships with our different debt fund partners. Now, that doesn't even include actually our own proprietary bridge product lending. We quadrupled that originations year over year. And we're really excited about 2022 and some new partnerships we're going to roll out on the bridge fund side to provide more proprietary products for our customers. As Keith referenced on the affordable housing side, it really was truly a banner year for Berkadia. And David Leopold and our team in affordable originated over $3.3 billion in affordable housing loans last year. So it's momentum that we're continuing to build on, and we look forward to an even more productive year with that team in 2022. Aneta piqued my interest when she talked about 8 interest rate hikes in the coming months. So I wish I had my crystal ball to think a little bit about what rates are going to look like in the coming year. But one thing, to just keep in mind is that despite the volatility and widening from a Treasury standpoint that we've seen in the past 15 months, when we look at rates and pricing for multifamily lending a lot of us have been doing this 20 or 30 years, it still really has never been much better. And as Aneta said, the economy, inflation is going to be an issue, but there will be a normalized path of growth going forward. And it should be supported by significant fiscal and monetary policy. So right now, 10-year Treasury yields are hovering around a 173. That remains really low, despite the fact that they're up 100 basis points from the extreme lows of a year ago. Remember, we started 2020 at a 188. And I think I heard Aneta say she's looking at a 240 for the end of the year. That's really a much more healthy return to sustainable pricing level. So I think, I take that as a positive sign for our business. We can handle that from a financing standpoint. There's lots of liquidity out there. So, talk to your Berkadia representative about different options. So to sum up, as my colleagues have presented, we have many reasons to continue to be enthusiastic about the opportunities in the multifamily market. We're going to look to Fannie and Freddie to continue to set the standard for lending. But luckily, we will maintain and commit to our partnerships with our strong life company partners, bank partners, and debt fund partners to fill the needs not met by the GSEs or by HUD. And we absolutely anticipate increasing our volume this year to serve you, our customers. We pledge best-in-class financing execution, and we look forward to working with you in 2022. So with that, I will turn it back over to Dory for our Q&A. Thanks, Dory.
Thanks, Hillary. That was a great mortgage banking update. I'm excited to close out today's program with a Q&A. We received a lot of questions ahead of today's webinar. We will only be able to cover a few questions today, but we will be sharing responses to the other questions on Berkadia's social channels. So be sure to follow us if you do not already. I'll get started with the first question, and I'm going to address that question to you, Marianne. Considering the historical correlation between interest rates and cap rates, would you predict cap rates to go up if the Fed starts raising interest rates as it says it plans to do?
Thanks, Dory. I think the relationship between long-term treasuries and cap rates has been debated for decades. We've all heard, Peter Linneman, and now we're hearing Aneta Markowska and weigh in on this. And I think our perception has changed. Years ago, most of us, I think, believed that there was a relatively direct and linear relationship between cap rates and 10-year treasuries. In recent years, I think we've all understood that relationship to be much more complex. But in summary, although I would expect an increase in long-term rates to create upward pressure on cap rates, I don't think the impact will be necessarily immediate or linear. So one of the reasons I think we've seen so much private capital chasing apartments is that private buyers tend to use the most leverage. Debt has been extraordinarily cheap. And private buyers can drive to the most accretive equity returns using that cheap debt. And as the cost of debt increases, their metrics are going to change. I believe we can tolerate several rent increases before we'll see long-term interest rates exceed cap rates and the impact of leverage become dilutive. Certainly when that happens, some capital will start to move to the sidelines, and there will start to be pressure on cap rates. But from what I heard from Aneta in terms of, perhaps 3 interest rate, kind of increases over the next year, it doesn't look like that that's going to happen this year. We're going to see that enough pressure to really move cap rates in our space. I think today the relationship between cap rates and rates on 10-year treasuries have been complicated by the Fed's use of its balance sheet to hold down interest rates and the cost of capital. And unfortunately, as we unwind that, no one really knows how large this impact is going to be. So that's going to, I think, complicate the equation a little bit further. But for the upcoming year, I do not see extraordinary pressure on cap rates based on what we think is going to happen with short both Fed fund increases and 10-year treasuries.
Great. Thanks, Marianne. Great response. We'll move on to the next question, actually. And Hillary, I'm going to address this one to you. How will inflation impact commercial loans?
And the way I'm going to tackle this, it's actually kind of similar and consistent with what Marianne just shared. But, we haven't had meaningful inflation in decades. So there's not great data to look at, but, with multifamily, we can just start out with the principles. Even inflation across the price of everything, so prices and interest rates, shouldn't really threaten multifamily from either an owner's perspective or a credit perspective, because, as most of us know, multifamily is often considered an inflation hedge, because unlike many long-term lease structures that are in place for office or retail or industrial, inflation is able to be passed through to tenants quickly before expenses can squeeze property incomes. So like Marianne said, on values, we'd expect that cap rates should hold fairly steady with moderate inflation. Although interest rates should increase, owners should be able to expect higher NOI growth, and residents will be willing to pay more. That said, there are a few places where this could get messy. And Aneta, I was encouraged to say that we think wage growth will stay strong, but if wages don't keep pace with costs, real rents might decline and NOI could decrease. More importantly, the threat of Fed intervention, and depending on, this Goldilocks scenario, if the Fed raises rates past a neutral rate, it would be intended to cool the economy, which could harm real rents, and owners would expect long-term NOI growth to slow, and it would put an upward pressure on cap rates. So this is probably why delinquencies went up in the late 70s when the Fed increased rates, and then you got stagflation, recession, and cap rates were high through the late 70s and early 80s. So, moderate inflation isn't scary unless it gets too high and forces the hawkish Fed. So it's going to be interesting to watch this year.
Great. Thanks, Hillary. Just moving along. One of the next questions has to do with ESG and how will the role of ESG and capital markets evolve in 2022? And I'll actually answer this question. First and foremost, to quantify the significance of ESG investing is estimated at over 20 trillion in AUM today. So it's a large part of the investing universe. ESG is very important, and we're finding more commercial real estate investors progressively considering ESG when underwriting and operating properties. But I think the ongoing pandemic and the demands of capital have definitely spurred more attention on ESG, leading to further adoption throughout each stage of a property's life cycle. So when it comes to multifamily, many investors are classifying affordable housing to satisfy ESG requirements. Therefore, investors are looking at investing in affordable housing, whereby they are helping underserved communities to generate positive long-term outcomes for residents and investors. But honestly, we at Berkadia are really energized about the heightened awareness and attention on ESG. And we think we're going to see more of this, just come through in 2022, where investors are instituting ESG measures across the country. And we're actually prepared to help those investors identify ways to achieve their goals. So look to Berkadia as a partner as you're looking to identify and opportunities surrounding ESG. So I'm actually going to move on to the next question, and I'm going to address it to you, Hillary. What kind of roles does Berkadia plan to play in 2022 regarding DEIB initiatives?
Thanks, Dory. This is actually a topic that's near and dear to my heart. As I chair Berkadia's DEIB committee, we embarked on a thoughtful and focused diversity, equity, inclusion, and belonging strategy 2 years ago. It's funny, actually, when I was looking at the slate of speakers today, I was so proud of Berkadia that 4 of our 6 speakers and the leaders of our key production business are diverse candidates. That wasn't related to my answer, but I mean, I think it's a topic that's very important to us. This year, we are going to be focused on three key areas, and we're really intentional about what we do try to accomplish. The first, learning and development. The second, recruitment. And the third is employee and client engagement. Around learning and development, we're launching a more intensive learning and development strategy with our employees, and reflect, we want to reflect the overall DEIB needs of the business and really drive success towards meeting sustainable goals. So that's going to be a lot of education with our existing team. Secondly, around recruitment. And, I think all of us out there in the commercial real estate industry are focused on this. How do you get more diverse talent into our organizations? And then how do we create a sense of belonging to grow their careers? We have several really productive partnerships to do that have worked well. Future Housing Leaders, Project Destined, Crew. So we're just going to continue with those partnerships and making sure we get diverse slates of candidates coming in to our organization. And then lastly, on the employee and client engagement side, we're continuing to support, and this is around belonging, employee resource groups, like the Berkadia Women's Impact Network, BWIN, our Pride groups. So how do we help employees build more of a sense of community with diversity? And then also with our clients on client engagement, we had a very successful Women in Commercial Real Estate conference late last year with over 120 Berkadian women and clients. We'll do that again this year and look at other partnership opportunities with clients. So lots going on and lots that we're excited about.
Great. Thank you, Hillary. Well, in the interest of time, I believe that's all the questions that we'll be able to answer and cover today. And now I'll turn it over to Justin Wheeler to close us out. Justin?
Thank you. Thanks a lot, Dorian. Thanks to everyone who shared your insights. What a great team we have here at Berkadia, and I'm very confident and grow more confident all the time we'll be able to help you as you build out your businesses as well. As you've heard today, we're very confident and positive about the multifamily fundamentals in 2021. And while the nation certainly has a ways to go in its economic recovery, the outlook for multifamily is positive. As a reminder, a recording of this webinar will be available shortly, as well as the results from our latest Powerhouse poll. Our full 2022 forecast, an analysis of multifamily trends paired with market-specific highlights, is available for download at berkadia.com. As always, please don't hesitate to reach out to any Berkadia professional with questions or follow-up. She or he will direct you to the right resource to get you the answers and insights that you're seeking. We're here for you. Cheers.